Good morning, class. Good morning, everyone.
Morning.
Yeah, put on your camera. Okay, have you review back what we have covered and any problem so far? Correct?
So far no problem.
No problem. What about your tutorial? Have you done your tutorial and then how was the discussion?
Yeah, just the tutorial.
Huh? Okay, guys.
Uh, okay, I just the ledgers there's a lot to write.
A lot to write.
Need to one by
Yeah.
one. So
Just,
afraid,
I mean,
afraid.
of course, a lot of things that you need to prepare, especially when you prepare in Excel form. You must know how to draw and how to record, and you record according to the step that are given to you. Okay, the first step, but after that, the second step. The point of reference is your primary. Okay, right? No, your camera. Here we finish off the chapter 4. Okay, before that, let us record. You can see my screen now. So remember, okay, the formula that we have learned. Okay, so we must get gross profit and we must get net profit. Okay, so how to find all this? These are the main objectives in order to get, in order to prepare SPL. So SPL stands for Statement Profit or Loss, and for the year ended, okay, for the year ended, then 31st of December 2021, for example. Okay, how to get gross profit? Sales, you less cost of goods sold. Then you get gross profit. Okay, gross profit plus other income and then less other expenses. So this is what we have learned in the first chapter. That is, we have two types of revenue. Okay, sales is the first type, and second is the other income. Whereas expenses also two types. First one is cost of goods sold, and then the other one is other expenses. So why we have these two categories, like what I've said to you, this is for presentation purposes. Now, when you prepare statement profit or loss, you have to prepare in three columns. Okay, the first two columns is to do the adjustment. Then the third column is where we put all the net figure after the adjustment. Now, normally the first column we're going to use after. See, and if we have a lot of related costs on purchases, okay, like the cost of goods sold, of course, the formula is generally opening inventory plus purchases less closing inventory. This is what we have. Yeah. So meaning if we only have this component, then we put into the second column. But if we have further expenses on purchases, then you need to do the adjustment. Okay? Purchases, you need to less return outward, and then plus with all the related costs on expenses. So we have wages, we have carriage inward, or even insurance on purchases. Okay, so when we do all this adjustment, so we actually getting the actual cost of purchases. So we have to take this into account and show it in this statement profit or loss. So that's why we have three columns. Okay. So the first column is to show all these costs related. Okay. So this is what you need to understand. Now, very easy to what we call that, to identify. Okay. In the statement, in the trial balance, normally you'll be given a list of all this account. This is from the main ledger, from the general ledger. Okay, so what we have here, this one, trade receivable. This is the trade receivable control account. And what we have in the trade payable, also this is from trade payable control account. Okay, which trade receivable controlling the sales ledger. Trade payable is controlling the purchases ledger. So everything is inside this total amount. Okay, so this list of account is from the general ledger because general ledger has a complete account. So debit side, remember, asset and expenses. Credit side, we have liability, equity, and revenue. So you need to be able to identify asset, liability, equity. All this will be in a SOFP, statement of financial position, and revenue and expenses in SPL. So SPL, this one, statement profit or loss. So you need to remember the format. Any problem with this format? Can you understand?
All of them is just total up. The rent, if there's multiple instances, you just total up into one rent there only.
Was that the rent?
Yeah, that's it. Like rent and utilities. Also, the utilities, they count all the bills, like the water bill, electricity
Yes.
bill, all together inside the utility.
Yes. Is a group name for the expenses. Okay, on the debit side, you will see all these expenses. Not all. Some of it is an asset. So how do we identify the asset? Okay, like land and building, of course, this is asset. Okay, motor vehicle, asset. Pictures and fitting, asset. Furniture, asset. Office equipment, asset. Trade
So it's
receivable,
asset.
asset.
So
Huh?
when the debit part is asset and
Expenses.
expenses,
Yeah.
and
So
then
this one also asset.
the credit side is
Except for equity, equity drawing. This one is on the debit side. So this is showing uh, how do we record in the equity on the debit side. Okay. So this one bank bank supposed to be an asset, but then it is on the credit side. So showing bank overdraft. So liability.
okay.
Okay. Right. So we have identified which one is asset. Okay. So the rest of all the debit side is expenses. Okay. So this one is an asset also like inventory, but then we put together as expenses. Okay, purchases. So this is expenses. So very important for you to be able to identify which one is expenses. Okay. Why? Oh, sorry. Oh, yeah. Because if it's expenses, it doesn't go to SOFP. Okay. This goes to SPL. So we have identified. All right. On the credit side, so revenue. Yeah, revenue, liability, and equity. Of course, sales definitely revenue. Okay, look at on the credit side only 1,000. So other revenue, other income, interest receipt, also other income, other revenue. So this one other revenue, other income. Rent receipt, other income. 49, very easy to identify equity. So this is capital equity, bank loan. liability. Yeah, long-term liability. Mortgage loan liability, trade payable liability, current liability, other payable liability. So by identifying this, you already allocated which financial statement you need to put all these items in the trial balance. Okay, so you have seen, yeah, this one we have covered. So remember, this is only recap. So trading account, if it's required by the question, so it is only showing the gross profit. Okay, trading account perniagaan, only showing the gross profit. So remember, trading account is part of the statement profit or loss, but you have to follow the requirement of the question. That's why you show this format twice. Okay, the first one because the question specifically asking for trading account, then you only show gross profit. The second requirement, the question asks you to prepare statement profit or loss. So again, you need to repeat showing the gross profit. Okay. So remember, the main formula is sales less cost of goods sold. Right. So since we don't have any cost related with purchases, so we don't use the first column. Straight away, we record into the second column because we only have the main item in the cost of sales, opening inventory plus purchases less closing inventory. Then after we get the net amount, then we put into the third column. So remember, this is minus, so less. Look at this. Look at this sign. So this is less. So less meaning negative, negative 24. Then minus 21,000. So this is your gross profit. Okay, I've already explained to you also. Less is actually representing debit entry. Okay, then add this one. If it's add, so this is credit entry. So income, all the other income are put into the second column. So by listing all the other income, then the net amount after you add it, then you put into the third column. So plus with the gross profit. Then you less. So this is debit again. Debit, expenditure, all the other expenses. So you list down on the second column. Okay, after you have added, then you put the total into the third column and make sure you put negative 9,005. So then you get the net profit. Okay. Then, so the net profit belongs to the owner. So you put under equity. So first of all, the capital that we have identified, so 49, okay, we have the additional information saying father gave him additional capital 10,000. So you add, then add with the net profit that we have calculated from statement profit or loss, 16,000. Then less with the growing. So growing, as I said to you, it is on the debit side, showing how do we record in the equity side, which is we less the growing, so 9,000. Why we less? The explanation is because the owner takes out the resources from the business, so the equity reduces.
Or
So that is
if the profit is a loss, do we write net loss?
the loss also negative.
No. If we write less? Do we write less and then we write net loss instead of net profit? Instead of
Yeah.
add and then net profit.
Or you mean like this lah? You put if it's net loss, then you must put like this lah.
Yeah.
Okay.
Less and
Then
then
you minus.
net loss and then we use the minus instead. Oh, okay.
Okay. Because it's opposite from net profit. Okay. Then after that, you total the closing capital. So 75,000 minus 9,000, then we get 66,000. Then put on the third column.
Oh yeah, the tutorial they didn't say the year. Do we just assume? Do we just write the year 2021, or we can just not write the year?
In the tutorial, it didn't show this one.
It didn't show the year. It only
But then
show
put
May
like
or March.
any just put like that. Or either if you want to put and also, but as long as it is consistent. If you
Oh,
use 2020, then opening must be according to 2020. Like this one, it's not calendar year. Yeah, it's not
yeah.
calendar year. So 1st of June 2017, closing will be 31st of May 2018.
So we still need to write the year, but
Yes.
consistent on yeah.
Yeah, but then it must be consistent. Yeah.
Okay.
So if this one, you want it to be 2021. So this one should be 2020.
Okay.
1 year. Okay. And then the non-currentability is the repayment period more than 1 year, put under this category. You list down after the equity, then followed by the current liability, repayment period less than 1 year. Then you list down your asset. So when you total, this total should be the same as this one. If it's not the same, you have to check something is wrong with your posting. Okay, so the heading statement of financial position at 31st of May 2018. Then you list down all the non-current assets. So put on the second column first, and then the total put on the third column. Okay, so same goes with current asset. After non-current asset, then you put current asset. Okay, and this is your closing inventory, not opening, closing inventory. Okay, so trade receivable, other receivable, and remember the bank just now, we have to take into consideration all the additional information, number 2 and number 3. So this is your opening balance for your bank. And then the second information says the father gave him 10,000 as an additional capital. And the third information saying here reimburse the petty cash. So how do we determine 700? Okay, because we are using impress system where the repayment will be according to the amount that is being spent. So spend the leftover of the petty cash is 100 and the float is 800, isn't it? So therefore, automatically we know 800 minus 100. So that is indicating the amount spent from the petty cash. So reimburse. So added back 700. Okay, this one is we get from the bank. So this one is less 700. Then you should be having the same total amount. Okay, that is for illustration number 2. So we go to the other part. Okay, that is from the transaction. Okay, and then look at the question. Record the above transaction into the T account. So T account meaning referring to the ledger account. Where can we have a ledger account? In the main ledger, general ledger. So in this question, did not ask you to do the prime entry. So we follow according to the question requirement. So that's why you might ask yourself, hey, how come there's no prime entry? Because we follow by right, we should have a prime entry first, then record in the ledger. But then since the question wants to test your knowledge, okay, understanding the question, so we open up a ledger account. So let's read. So you need to understand or identify the 2 items involved for every transaction. Now, Shane started the Wallaway civilian shop operation on the 1st of May 2018 with 1,005 cash and 10,500 in Eon Bank's current account. Started, yeah, the keyword here is started. So meaning this is actually your starting capital, isn't it?
Capital.
Which is 1,500 in cash form, and then 10,500 in the current account. So that is indicating to you capital as equity, and then how much? So you plus this to 12,000, and then that is, remember, capital is equity, isn't it? So we have cash and bank is an asset. So meaning we have bank debit. Okay, before we don't have bank and cash, but after that we have bank and cash. So that is telling us these are the three accounts involved for the first transaction. Capital, of course, this is credit. Bank and cash will be debit. So we're gonna do that in the ledger account later. And then identify the keyword first. So me, the second, she bought office equipment. Office equipment paid by check. So these are the two keywords. So this is bank, this is office equipment. Asset and asset. Both is asset. So meaning this increase, so debit, office equipment, check decreases. So you have to credit check. So let's go through first. Identify the keyword. So in your side, please mark the keyword. Purchase 50 units of goods at 200 each from Groovy Enterprise on a credit term. So because of credit means secara hutang. Okay, so meaning, and you see, this is good. It doesn't give you specific, isn't it? So meaning we can assume this is the trading item. So 50 unit at 200. So meaning 50 times 200. Yeah? So 50 times 200, how much? 9,000. With my calculator. Okay, 50 unit times 200. So 10,000 on a credit term of 30 days. So the keyword purchases and Groovy trade payable, Groovy Enterprise. Early settlement by check keyword from Groovy Enterprise was made at a cash discount of 10%. Okay, so Groovy Enterprise. So Groovy Enterprise reduce, and then the check also reduce. Okay, so meaning this one Groovy will be debited, bank will be credited. If this is, if we are sure this is debited, then this one definitely will be the opposite credit. But then you have a discount here, discount receipt. Okay, so discount received 10% of 10,000. So 10% of 10,000 is 1,000. So meaning the check amount is 9,000. So 9,000. Okay, just identify the keyword first. Put in additional capital 1,000 into the business bank account after she won the money in the contest. So capital and bank, that is a keyword. So meaning increase of capital, increase of bank. So follow the double entry rules. So bank will be debited, capital will be credited. And then sold 8 units of goods, 400 each to customer on cash term. So cash term, meaning cash sales. So increase of cash, increase of sales. So this is the keyword, increase. Okay. So credit item, so you credit sales. Debit item, so you debit cash. But then
it
you see,
says,
yeah,
yeah, it says each there. I don't know how many customers also.
come again.
Oh, it says sold 8 units of goods for the 400 each, but
400.
we don't know how many customers.
No, you just type.
Yeah, okay, I read it. I read it wrong. Okay, I read it wrong. Sorry.
Yeah, 8 unit and 400 each. So 400 times 8, 3,200. Yeah. So 400 each is referring to each of these units, not the customer. Okay. And we'll bank in the next day. So meaning one day gaps, isn't it? So at first we have to park in the cash account first. Then next day, so we have to take out, we have what do you call that, contra entry here. We have to reduce cash the next day, and then we increase the bank because of this wording. All the proceed will bank in the next day. Okay, we will see the the entry later. And obtain 50,000 bank loan from Eon Bank, which was immediately banked in. So we have bank loan and immediately bank in. So this is an asset increase. So debit bank and credit bank loan increase also our liability. Paid advertising expenses 3,000 to direct media by check. Okay, advertising by check. So these two keywords, advertising and check. So since it's been settled, so we don't need this name. So the bank, okay, it will reduce and the advertising expenses increase. Okay, we debit advertising, we credit the bank. 14, so far, can you follow? Can you understand? Sarah? Sarah? Are you okay? Can you understand? Can you hear me? Yeah, Sarah, I'm asking you.
Hello. Yes.
Can I? Oh, okay. All right. Noah, what about you? You okay? Am I lagging, Alvin?
Oh, I think it'd be easier to understand if the can
Okay,
see the ledger. lah. But
right.
I think I can get the idea how to like,
Oh, good. 14. Bought a delivery van from Ascent Motor costing 10,000. Okay, delivery van. So meaning motor vehicles. Ascent Motor. So we need this name because partly paid by cash, 1,000, and the remaining amount to be settled next month. Okay, so cash. So these are three items involved. One is delivery van. Okay, and then we have other payable because this is not trading item, isn't it? And then we have cash. So cash reduced 1,000. Okay, the delivery van increases and motor vehicle, trade payable, not trade payable, other payable also increase. Okay,
still
we
this
got that.
this still right in one ledger account. Still
Uh, three accounts here.
three accounts.
One
So
is delivery van, one is other payable asset motor, and the other ledger account is cash account.
this one we use three ledgers to write
Yeah, three accounts. We don't call it ledger
three
account.
accounts.
Three accounts. Okay, ledger, we have sales ledger, purchases ledger, and main ledger, the general ledger. So we don't call it ledger, but we call it accounts. Okay. Right. And then 17, sold 20 units of goods for 400 each. Two in maximum number one. So meaning this 20 unit, 400 each. So times not 20 times 400, so 8,000. This is to Emacs, meaning it's credit, yeah, credit sales. So credit sales, so sales account and trade receivables, Emacs. Remember that is the keyword. And then on the 18th, issued check 2,000 to pay for the owner personal life insurance. Now, whatever that is personal expenses of the owner, whatever type it is, we call it drawings. Okay? Drawings. So one account only, drawings account. So there are two, check and drawing here. Okay? So check reduces. So this is credit. Debit will be the drawings account. Now 29, bank in a check 250 as commission received. So increase of check, increase of revenue. Okay, so debit, bank, credit, commission received. 30th, purchase 30 units of good at 200 each. Again, so 30 times 200, yeah, 6,000. And from Groovy Enterprise on credit term. So meaning this is credit purchases. So this is credit payable, Groovy Enterprise and purchases. And the last one, paid office electricity by cash. So electricity and cash. This is the keyword. Okay, reduce of cash, increase of expenses on electricity. Closing inventory. So you're given it. So additional information. So record the above transaction into the T account. And then after we have recorded the T account, and you are asked to prepare the trial balance. So definitely the question wants you to do the process of if it's expenses, revenue, we have to close off. If for asset, liability, and equity, we have to balance off. Okay, and then prepare the statement profit or loss and prepare the statement of financial condition. So those that is being closed off, we put into statement profit or loss, revenue and expenses. Those that we have balance off, then we prepare, we put into the statement of financial position. Okay, let's go through one by one. So first thing, that you just look at my the answer and then I read the transaction. Now let me read back the transaction. Started operation on the 1st of May with 1,500 cash and 10,500 in Ion Bank current account. So meaning we open up cash account and bank account. And also remember the three items that we have identified, the capital account. Then identify the effect of the transaction. Okay, first thing, capital is under equity, credit item. So increase. Before we don't have capital, now we have capital. So that's why we credit 1,005 in the capital account and then 10,005 in the capital account also. And the particular we need to write down in the capital account, cash account and bank account. It's stating, so we have to open up cash account and bank account like this. And this is the heading of the account that is being debited. So we debit 1,005 in cash account and we debit 10,500 in the bank account. In the particular, we write down capital. This one also capital. And put the date according to the date of transaction from the question. Is it okay? Okay, moving on. So May the 2nd, she bought office equipment with 1,000 paid by check. So by check, so meaning affecting the bank account. So looking at the transaction, the check, like what I've said to you, reduces. So we credit 1,000 in the bank account. And in the particular, we write down office equipment. Okay, we write down office equipment and we have not opened office equipment yet. So we open office equipment account and complete the double entry. That is putting 1,000 on the debit side and the particular write down bank. And the date is May the 2nd. Can you understand?
Yes.
Okay. So I can continue. So on the 4th, purchase 50 units of good 200 each from Groovy Enterprise on a credit term of 30 days. So this one should be, the prime entry should be purchase journal, but then we are not required to open up. So we only required to do a ledger account. So open up purchases account. Okay, because we have identified this now. Purchases account. And in the purchases account, since this is an expenses increase, before we don't have the purchases from Groovy, but now we have. So your times 50 unit times 200 is 10,000. So we debit 10,000 into the purchases account. And the particular you write down trade payable Groovy Enterprise and the date May the 4th, and complete the double entry by opening trade payable Groovy Enterprise account and put the 10,000 on the credit side. Just now we debit, isn't it? So you must put on the credit side. In the particular, you write down Jesus and the same date of transaction. Okay, so we have done on the 4th. Now on the 7th, early settlement by check of the above purchase from Groovy Enterprise was made at a cash discount of 10%. Check, yeah? So meaning we have identified just now the bank is being reduced. So first thing, record in the bank account, we reopen bank account. So we don't have to reopen the bank account, but record it, combine it in the same account. So this is reducing. So we credit, okay, the amount of check is 9,000. Yeah? 9,000. So that's why we record 9,000 here. And the particular you need to write down, okay, the trade payable Groovy Enterprise. Okay, and the date on the 7th. Then we have to open up trade payable. I mean, we reopen it. Reopen. So just combine it. Now the effect is reducing. So therefore, we put 9,000 on the debit side of trade payable Groovy Enterprise and put the particular as bank, May 7th. So initially it's 10,000, isn't it? But then because we paid earlier, so we have the difference, okay, which is 1,000 is coming from the discount receipt. Okay, 10% of 10,000, so 1,000. So we debit trade payable. Otherwise, if we don't do this entry, okay, there will be redundant 1,000 here because the original amount is 10,000, isn't it? So we have to put in the remaining as a discount. So that's why 1,000 is being debited in trade payable Groovy Enterprise account. 1,000 here. And the particular you write down discount receipt and at the same date. Then open up a discount receipt ledger account. So this one. Okay, remember this is a revenue. So before we don't have the 1,000, but now we have. So increase of discount receipt of credit item. So we credit 1,000. And then the particular, again, referring to the name of account that is being debited. So we have debited trade payable Groovy Enterprise. So put here trade payable Groovy Enterprise. Okay. So then on the 7th, now we look at the transaction on the 8th. Put in additional capital 1,000 into the business bank current account after she won the money in the contest. So capital and cash. Sorry, bank. Okay, capital and bank. So we have opened the capital, we have opened the bank. So we just record in that respective account by looking at the effect the transaction towards capital increases the credit item capital. So we credit the 1,000 in the capital. And the particular, you write down bank. Okay, in the bank account, so is an asset, a debit item. So increase of bank, so we debit 1,000 and put the particular as capital, meaning the name of account that is being credited. And the date will be March 8th. So the same as this. Okay. So we have done on the 8th. Then on the 9th, sold 8 units of goods for 400 each to customer on cash term. Okay, that is the first transaction. So meaning the keyword, like what I've identified to you, the sales and cash. Okay, and then get the amount, 8 units, you times with 400. So 3,200. So cash, a debit item increase. So we debit 3,200 and the particular, okay, will be sales. And the date will be May 9th. Then sales account we have not opened, so open a sales account and complete the corresponding entry. Just now was credit. So sales account, okay, we put credit because this is credit item. Increase of credit item. So you credit 3,200 in the sales account. And the particular, you write down cash. And the date, May the 9th. See. Okay. So that is one transaction. The other transaction, uh, the other transaction says, what was it? All the sales proceeds will bank in the next day. All the proceeds will bank in the next day. So meaning your cash and bank. So cash reduce 3,000 with the same figure, 3,200, because we took out this amount from the cash and put into the bank contract. So in the bank, 3,200. So make sure in the bank account, the particular, you write down cash. In the cash account, the particular, you write down bank with the same thing. Okay? The next day on the 10th. Now, is that clear?
Okay.
Yeah.
Okay. All right. On the 11th, obtain 50,000 bank loan from Eon Bank, which was immediately banked in. So the keyword, like what I've highlighted, okay, bank loan from bank, and then after that, bank in. So your bank account increases, a debit item increases. So 50,000 we put on the debit side. So 50,000 put on the debit side, and then the particular loan, Eon Bank. Okay, on the 11th. So complete the double entry by opening a liability account, loan, Eon Bank. And this is a credit item, so increase of credit item, so you credit 50,000. Complete the double entry. Just now was debit, so this one should be credit. And the particular, you write down bank. And the date, May 11th. Okay, and then on the 12th, paid advertising expenses 3,000 to direct media by check. So advertising expenses and check is the keyword. So the bank already open, so you only need to open advertising account, and this is an expenses account, a debit item. So increase of the debit item, you put on the debit side 3,000. Record on the debit side 3,000 in advertising account. And the corresponding account in the particular, again, is bank. Okay, meaning in your bank account, okay, so you have to credit advertising 2000, and me the total. The heading here, the particular, you put advertising. On the 14th, bought a delivery van, the keyword delivery van from a San Moto costing 10,000, paid cash 1,000 and the remaining amount to be settled next month. Okay, first of all, so open up a delivery van account, okay, to record it. Delivery, so delivery van under motor vehicles. Okay, so increase of a debit item. So therefore, we record the net, the 10,000. Okay, so out of the 10,000, 9,000 from other payable, and the other 1,000 coming from cash. Okay, so other payable. Why other payable? Because motor vehicle is not trading item. So that's why other payable, ascend motor. Then cash already open. You need to open other payable only. Other payable, then complete the double entry. This is debit. So other payable, send motor will be credit. So 9,000 already completed. But cash we have not completed. So we have to credit the cash account. So credit the cash account 1,000. So the particular you write down motor vehicles. Okay. Any question on this? Can you understand?
Hi.
Yeah.
Right. So 17. Sold 20 units of goods for 400 each to Emax and Berhad on credit terms of 30 days. So like the highlighted word sells, okay, and Emax and Berhad. And the total you times 20 unit times 400 each. So you have sales account you already open, so no need to reopen. So record in the sales account. So where is the sales account? Okay, this is the sales account. So credit item. So we credit 8,000 in Max and Berhad and open up trade receivable in Max and Berhad. Complete the double entry. So this is the time. Okay, 8,000 and then particular trade receivable in Max and the date 17. So complete the double entry. So we have to debit trade receivable in Max. Okay, 8,000 into trade receivable in Max and Berhad account. And the particular you write down sales and same thing. Okay. On the 18th, issued a check 2,000 to pay the owner's personal life insurance. So the check and personal life insurance. But then personal life insurance, we don't have to open that account because whatever that is being taken out by the owner, so we only record into one account, that is growing account. Okay. So the check is reduced, isn't it? So that's why we credit the bank. And where is the debit? The other corresponding entry must be debit, so it should be the growing account. And look at this, the particular is bank. So complete the double entry, okay, by crediting the bank account. So we credit the bank account, okay, for 2,000. And then particular, okay, showing the name of the account that is being debited, province. And the date is on the 18th. Okay, on 29, bank in check for 250 as commission receipt. So the keyword that I have highlighted to you, bank and commission receipt. So meaning your bank increases. So that is why 250 is being debited. And the name of account that is being being credited will be commission received. So we have not opened commission received. So we open up a commission received account. Okay, commission received account, that is this one. And complete the double entry by crediting 250. And the particular, you write down the heading of the account that is being debited. So bank. And the date, May 29. Okay, and 30th, purchase 30 units of good at 200 each from Groovy Enterprise. Okay, we have opened up Groovy Enterprise and we have opened up purchases. So we just do the recording. The total amount is 30 times 200, about 6,000. Okay, 6,000. So purchases, okay, a debit item, we have to debit, yeah, okay, increases. So that is why this is being debited 6,000. And then the particular, you write down trade payable Groovy and the date, May 30th. So you complete the double entry by crediting the Groovy 6,000. And then particular, you write down purchases and the date is March 30th. Then the last one is paid office electricity by cash 16. So open up electricity account. So this is electricity account. And this is an expenses. So before we don't have electricity, but now we have this electricity expenses. So debit item increase. So we do a debit increase 16. And then the corresponding account, that is the heading in the particular will be cash. Yeah? Okay? So meaning we have to complete the double entry by crediting your cash account. Okay? Crediting the cash account 40. So done. We have completed all the double entry in the general ledger. Okay, all the accounts. So now, so cash, this is an asset. Bank account is an asset. So we have to balance off. Okay? So balance off. That's why how to balance off, remember, since we have to do total line, it must be the same row on debit and credit side. Underneath double line, upper is single line. Then choose the highest amount. So compare, so debit is more. So 4,700. So use 4,700 as total for both sides. So credit also 4,700. In order to make the total credit 4,700, so we have this balancing figure 440. Okay, how do we get this? 4,700 minus 3,002 minus 1,000 minus 60. So the remaining is 440. So this is because it's above, above the total line, isn't it? So this is balance sheet. Below the total line can be balance sheet. So you have balance sheet. So what balance is this? Okay, since debit total is more than the credit side, so this is debit balance. Okay, so 440 debit balance. So you need to put into the trial balance as debit. Yeah, 440. If you look at your answer, for your trial balance, this cash book is put on the debit side, 440. So the bank account, we do the same thing. Okay, put the total line and then compare. Debit is more also. So 64,950. Use the total as a total for credit side as well. And you minus, then you get this balancing figure 49,950. So this is debit balance as well. So in the trial balance, you put on the debit side. Capital account, okay, we put this one also we have to balance off. So total Okay, we only have credit total that is 13,000. So use that 13,000 as total for both sides. And in order to make the total debit 13,000, so we put this 13,000 here as balancing carried down, and you will have balance brought down underneath. Yeah? Okay, balance brought down. Okay, 13,000. So credit balance. This is credit balance. 13. Okay. So why credit balance? Because total credit is more than the debit side. Can you get it? Next one, office equipment. So we only have since we only have one entry here, 1,000. So we can do this closing also. I mean, in this manner. So we just underneath we put a double line and balance CD. Okay, underneath also double line. So it's the same thing. Like you want to put this in the total line, but since only one transaction, one entry here, so we can do this kind of closing. Okay, we don't have to put upper line single. Yeah. Okay, we don't have to put only underneath. We put double line, and we put another figure here, 1,000, and do the double line. So the particular you write down balance CD, and the opposite balance PD. So debit balance 1,000. Office equipment. Yeah? Purchases account. So this is an expenses. So expenses we have to close off. Close off meaning, okay, we are going to post this account, the amount of purchases into SPL. So we have to, okay, make the opposite because this is all debit, isn't it? So make the total line first. So 16,000 is higher. So use the 16,000 as a total for both sides. And this amount will be posted to SPL. Okay, meaning we close off this account by posting this amount. Okay, we credit purchases and we debit SPL. But in SPL, we don't see debit entry, but we only see less because it was prepared in the statement form. So less is representing debit entry. Okay, and this is representing credit entry. Right? So trade payable. So this one is liability. So we have to balance off. So how do we close? Okay, like this one. Okay, which is we have to make a total line. And since credit total is the highest, so we use that 16,000 credit total as total for both sides. And in order to make the total debit as 16,000, we have a balancing figure of 6,000, okay, as the credit balance. Okay, CD above the total on that side, balance BD below the total will be on the credit side. Okay, so discount receipt. This one is an income, so meaning we have to close off. So close off, okay, by debiting discount receipt and we credit into SPL. So credit SPL, again, there's no credit entry, but then you only see less and add, isn't it? So this will be added. Sales account is revenue again, so we have to close off. Okay, by debiting the sales account and credit SPL. Loan, this is liability, so we have to balance off. This is liability. So this one is an income. Advertising expenses, so we have to close off. By crediting advertising, meaning this is credit 1,000 here, so in SPL it will be debit. So debit represented as loss. Motor vehicles, so this is an asset, so we have to balance off. So we have debit balance, yeah, debit balance, balance PD below the total on the debit side, 10,000. And then other payable, okay, this is liability. Okay, we have credit balance. Trade receivable, this is an asset, debit balance. Okay, drawing income, this one will be posted in equity. So that's why we have a debit balance. And commission received on income. Okay, we have to close off by posting to SPL. And then electricity is an expenses. We have to post off, we have to close off and post into SPL by crediting the electricity and debiting the SPL. So in your notes stated here, asset, liability, capital, and borrowing account. So we have to balance off. So meaning this will appear in the statement of profit or loss. Whereas the sales, the income, okay, the purchases and expenses, okay, it will be put into SPL. So before we proceed to the statement, to the financial statement, we do the trial balance in order to check whether have we observed the correct double entry. Okay, so we put into the debit side and credit column. Okay, debit column for asset and expenses. Asset and expenses. And then credit column, equity, liability, okay, equity, liability, and revenue. So this one, expenses, asset and expenses. So we should be having total debit 90,450 and credit also the same thing. Then from this trial balance, so use this to record in appropriate financial statement. So this is an asset, bank asset, capital equity, office equipment asset, purchases. This is expenses. So into SPL, trade payable, as this one is liability, SOFP. Discount received, this is income, SPL. Sales income, SPL. Loan liability, SOFP. Advertising expenses, SPL. Motor vehicles is an asset, so SOFP. Other payable, liability, SOFP. Trade receivable and asset, SOFP. Drawing under equity. Commission received, revenue under SPL. Electricity under SPL. Then record it into the appropriate statement profit or loss. So our SPL, remember, put the name on the top, Wallaway Souvenir Shop, and then the heading of your statement profit or loss must be ended with the word for the month ended or for the year ended. Since this is for the month, so we have to put as for the month ended to the 1st of May. And then use the column, but since we don't have other expenses involving purchases, so we don't use the first column, only the second column and the third column. So sales, okay, we put on the third column. Okay, we have to do the adjustment on cost of goods sold or cost of sales. So purchases, we don't have opening inventory, which has just started. Okay, we only have closing inventory. So 16,000 minus 10,000. So we have 6,000, the cost of sales. So you need to understand that. So meaning these are all good available for selling, 16,000. But what is the remaining? Okay, only 10,000 inside the inventory. So meaning the excess is the cost of sales. So that's why we put 6,000 here. So we minus, this is your gross profit. So add with all the other income. So we have discount received, commission received. Okay, we add 1,250. So this is the total income. Then less with other expenses, we have advertising, we have electricity. Okay, 3,060. So the balance. So this is your net profit. Then net profit, belongs to the owner, so it must be recorded in the equity. Okay, in the equity, so we don't have opening capital. We only have additional capital because just started, isn't it? So 13,000. Then plus with the net profit, 3,390. Okay, less drawing from the trial balance. Huh? So this is your closing. Then you have payment. Okay, that is note from Eon, 15,000. And you have other payable and trade payable. Okay, so 15,000. So total, you add all together, so you should have 79,390. So same goes with your assets, should be the same. Get the resources. Then list down your non-current assets. So office equipment, you have 1,000, motor vehicle, 10,000. Okay, what we have recorded in the main ledger, the general ledger. In closing inventory, this is from your additional information. So this is part of your current asset. Trade receivables, 3,000. The bank, okay, 49,900. And your cash, 440. This is after we have done uh, the balancing off. So we should having the same amount. If it's not the same, so check again each of this component. Now, can you understand the whole process?
Oh yeah.
Oh yeah.
Can I? Okay. Can we just have a short break? Yeah, probably 5 minutes. Then come back and continue with the accounting concept.
Oh yeah, the net profit there you color red. Do you also need to color red?
No need. That is only highlighting to you.
Okay.
Yeah. So you don't have to put color, red color. Okay.
Oh, this one didn't show year. It only show the month.
Because this one is because the report, the financial statement can be done on monthly basis or yearly basis.
So if it's monthly, we don't need to show the year.
Yeah.
Oh,
So we have to adjust the wording because if you look at the requirement here, it say as at 31st of May, month ended. So we have to follow according to the requirement. Okay. Kevin, did I answer your question?
yeah. Okay.
All right. So 5 minutes break. Huh? Are we ready? Put on your camera. Okay. So accounting concept and convention. So when we do the recording, okay, we have to follow a certain rules. Yeah. So why we have to follow the certain rules? Because of this, the concept that we are learning here, the accounting concept and convention. So this is all based on this guideline. So the recording of transaction in the books is for the purpose of preparing a financial statement, okay, which should provide information about the financial performance and position of the business. So when you see financial statement here, we are referring with statement profit or loss and statement of financial position. Okay. So in statement profit or loss is showing the financial performance. Okay. So financial performance, we will see the net profit of the business entity. And then the financial position here is referring to the statement of financial position, showing the asset, showing the equity, showing the liability of the business entity. So these financial statements are not used by owner of the business alone. There are a lot of other people who are interested in a financial statement, such as bankers, government, employees, suppliers, customer. So this you have learned in the first chapter. Look at the user. The user, we have internal and we have external. So what we are referring here now is we are talking about the external bankers, government, employees. Employees is internal, suppliers, customer, all these are external. So they are interested of this financial statement. So that is why when we prepare the financial statement, this has to be prepared based on the generally accepted rules, accepted procedures on how transactions should be recorded. So these rules have been derived and developed over the years from trade or business custom and general accounting practices, and they are collectively known as accounting concept. So this is what we are learning today. Okay, the guideline, the rules and regulation when we prepare the financial statement. Okay, so we have altogether, look at this, about 11 actually, but inside here we only have, oh yeah, 11, 12, 13, 13 altogether, accounting concept. So in the exam, from time to time, they will ask this in the theory part. So it's very important. Okay.
Sir, can
So,
you zoom in a bit?
yeah.
Zoom in a bit. Zoom in.
Zoom in. Oh, you mean too small?
Oh, yeah.
I don't know.
Okay.
Okay. So the first one is business entity concept. So business entity concept meaning the business and the owner are two different entities. They are separated. Okay. They are not considered as one in terms of when we do the recording. So that's why whenever we have a personal transaction, we don't record into the books. Instead, we put everything into the drawings, isn't it? So let's say if it's they've taken out the cash and paid for personal insurance or taken out for to pay tuition fee. So they don't put tuition fee. They don't put personal insurance because this is considered as a personal transaction. Yeah. So they group them into one account that is known as drawing account. Okay. So item recorded. Okay, that is a further explanation. Item recorded in the books of business accounting record, therefore restricted to the business transaction only. All the other personal transaction of the owner, it will not be recorded in this book. Okay. Now, whenever only what is recorded in the books of transaction, whenever the owner brings in or inject asset into the business. When they inject in the asset into the business, it could be in cash form, it could be an asset form, isn't it? So we record in the capital account, and then that is credit. And then what is the debit? So if it's in cash, then it should be debited in cash. If it's in check, should be debited in check. If it's a motor vehicle, then put into the motor vehicles. Office equipment, then put into the office equipment. So that is how we record. Yeah. So similarly, when the owner withdraw asset from the business, okay, this involves the business and it is recorded in drawings in the books. Yeah. It should be noted the drawings are only limited to sole proprietorship and partnership. So remember, we have a few business ownership, isn't it? Uh, we have sole trader, we have partnership, and we have company. So company, we don't have drawings, only in sole trader and partnership. Okay, so bear that in your mind. So drawing are not allowed in the business of a company. So that is the first one, business entity concept. Can you understand?
Yeah.
Okay, so moving on, the next one is going concern concept. So when we look at this word, going concern, going is referring to the word continuous, continuing in operation. Concern means we are talking about the focus. Yeah, continuing focus concept. Yeah, meaning it is assumed the business will continue to operate indefinitely for the foreseeable future. So meaning when we prepare the financial statement, we we assume the financial statement are going to continue not only today but to the following year, and then until we don't know until when, operate indefinitely. Yeah. So that is for recording purposes. We assume that they are going to continue. No intention to liquidate. Liquidate meaning they sell off the asset and then use the proceed to settle off all the liability. That is liquidate. Cease the business or scale down the operation of business at any point of time. Okay, so meaning we assume they're going to continue with no intention of selling off the asset and then pay for all the liability and then after that stop operating. So that is the assumption. Okay, that is why when we record the asset, okay, acquired by the business to generate income, they are recorded at the original cost. Let's say we bought 30,000 during the first year. Now we are in year 5. We still record the same thing. 30,000, we bought it 30,000. We record the same value, 30,000. Why? Because we have no intention, when we prepare this financial statement, we have no intention of selling it. But we use it in the business. So that's why the amount will be carried forward from one year to another year with the same original cost. So the significance of this concept is in the valuation of the asset and liability of the business. Okay, because we assume the business to continue in operation. So therefore, we value them at the historical cost. So if we assume the business is going to close down, this is the opposite, or cease, we will value the asset on the forced sales price, which are not the same as the historical cost. Therefore, how we see the continuity of the business will affect our valuation of this asset and liability. So, meaning that is why we record, especially the asset item, we record according to the original cost. So when we record at the original cost, this is referring to historical cost. Historical cost meaning cost that you have already incurred. Yeah, already incurred from previous year, isn't it? So historical cost. So because we assume we are not selling this, we are not cease the operation of the business. That is, we're selling off the asset. So that's why we don't record the asset according to the sales force value, force sales price. Okay. So meaning going concern concept is a concept that we use when we prepare the financial statement. As we prepare the financial statement, we don't record the asset, especially in terms of how much can we sell it now. Instead, we record according to the original cost, that is historical cost. Can you understand, class? By assuming that the business are going to continue the operation indefinitely.
We always assume it's gonna continue indefinitely.
Yes.
Uh-huh.
Unless, let's say, unless you have confirmed that you can't operate anymore, you have to stop. You don't. Your liability is more than your asset, so you have no other alternative to, to run the business because everything. I mean, all is losing, and then you don't have the capital to continue your operation. Definitely.
That one only comes later, like.
Yeah.
That only comes later. Okay.
That one is confirmed. You cannot proceed. So therefore, when you prepare financial statement, so meaning all the assets you have to record according to how much you can sell it. Now, you sell it, and then after that, you have to settle all your liability. So this is you are in a liquidity form, liquidity situation. Okay. Can you understand this concept?
Yeah.
Okay. Next one is money measurement concept. Money measurement concept, meaning a concept that is guiding us. So we only do the recording into the financial statement based on transaction that is measurable in terms of money, monetary unit. So accounting information is concerned only with those facts that can be measured in monetary unit, and most people will agree to the monetary value of the transaction. Whatever is not measurable in monetary terms cannot be shown in accounting record. Okay, there's a lot of factors that are important to the business but cannot be measured accurately in monetary terms, like workers' morale, motivation, workers' relationship with each other, staff welfare, workplace environment, quality of the management team, customer relationship, presence of competitors. So these are all crucial for the continuity of the business, but they are not shown or no recorded in the accounting record. So this is the one of the limitation of the accounting. So this concept is telling you, so we only record those that is measurable, transaction that is measurable in terms of money, which everyone agrees with this value. That's why we have the source document, isn't it? The source document is the evidence. How much is that the actual cost. Okay, so other factors like all this information are very crucial, meaning very useful to the business. Morale, meaning how motivated is the staff, the relationship with each other. Very important, because if the relationship is very good, then the company can survive. Okay, the staff welfare, the workplace environment, the quality of the management team, good management, quality management. Okay, this one you can't measure in terms of money. So that's why you don't see this in the statement profit or loss or the statement of financial position. Isn't it? So therefore, accounting record report statement can never tell us everything about the business. So the limitation can be overcome by the business providing some additional non-accounting information such as written report, explanatory notes, and survey, etc. So meaning when we prepare the financial statement, so everything we should put into the report, but then some of the transaction cannot be measurable, like what we have that example just now. So that's why apart from the financial statement, okay, we have notes of the account stated in the annual report, just to tells the I mean to inform the shareholders, yeah, about uh, reporting to the shareholders about all of this workers' morale, workers' relationship, okay, other information which is not been conveyed in the financial statement, okay, which is not communicated in the financial statement. So that is money measurement concept. So we only record those transactions that is measurable in terms of monetary unit. So those items, which is considered important also, but cannot be measurable in terms of money, so we don't record. Okay, so that one we can find in the written report, explanatory notes.
Example of the one of them, like the things that not measurable.
This one,
Yeah.
workers' morale,
Oh, oh,
workers' relationship, workplace environment, quality of the management team. All these are not measurable in terms of money. So we don't record this in the financial statement. Okay.
okay.
Right. Next one is accounting period concept. Accounting period is referring to the length of period that normally covered in the financial statement. Like we normally use calendar year. I mean, basically, it should be 12 months, isn't it? 1 year. So for accounting period, for a company, of course, the accounting period will be different from calendar year, but as long as it is 12 months. So accounting period is actually referring to the life of the business. And the life of the business, of which the life of the business is continuous. Like just now we were talking about going concern. The life of the business is a continuous indefinite period, isn't it? For a long period of time. But then you see, for control purposes, we have to divide the life of the business into equal length. Okay, equal length, 1 year normally, so that we can measure the performance and we can measure the financial position of the business entity for control purposes. So the period of 1 year normally coincide with calendar year. Calendar year, we are referring with January 2021 to December 2021. So this is a normal calendar year. Okay, so therefore, financial statements are normally prepared for each accounting period to assess the performance in terms of profitability, that is under statement of profit or loss, and the financial position in the statement of financial position of the business entity. Okay, So one of the accounting concept is accounting period. So accounting period meaning that is a period that we have to divide the life of the business into equal length, and normally it's 12 months, 1 year. Okay, just to determine the financial performance and the financial position of the business entity. Okay, that's why we have statement profit or loss for the year ended 31st of December 2021, for example. Okay, we are following the accounting period concept, or we call it time interval concept. Okay, either of these terms they use. So make sure you take note on that, so that whenever the question briefly explain time interval concept. So it is referring to accounting period also. Right? Would you be able to explain? No one? If this question come up in the exam, briefly explain time interval concept. What do you think? Oh, in your own words, in your own understanding from my explanation just now, what do you think? What is accounting period concept? What is time interval period?
Yeah, I think can, because in SPM I learned from BM, so just translate on.
Try. What in your understanding?
It's like have to be same duration lah. Like if 1 year, then the next what year also have to be 1 year length. Like one financial report have to be in the same year, continuously.
Okay. So meaning for the purpose, you have to state what is accounting period first, referring to what. So accounting period is referring to the life of the business. That is divided into equal period. So like 12 months. That is equal period. So remember, the life of the business is, we don't know, indefinite, isn't it? Will they stop? We don't know. So that's why the life of the business, we divide into equal length. That is the purpose of the word. Equal length.
So people usually document it, the accounting weekly, or they usually do it monthly or yearly.
It depends on the company. If they want to be more effective, they will do monthly. But then there's a lot of work. To do.
Nobody do weekly.
Weekly is not practical because weekly, it doesn't give you much information. So normally they would do it on monthly basis.
Okay.
Unless the company is, in 1 day they have like thousands of transactions, or probably they can do on monthly basis now. And they are using computerized accounting system, so that can be done. But if we do it manually, it will be very a lot of work to do. Can you understand what I'm saying?
Yeah.
Okay. That is the accounting period. So we continue. Historical cost concept. Just now we mentioned about historical cost concept. So the word historical meaning history. What do you understand history? Sejarah. So what is sejarah? Sejarah means the event already happened, isn't it? So we are talking about historical cost, not the situation, but this one we are the cost already incurred, referring to historical cost concept, meaning things already happened. This transaction already happened. Okay, so business activity are recorded at cost and prices at the time of the transaction. So that is historical cost. So when we record the cost and the prices at the time of that transaction, as such, asset acquired are recorded at the original cost or the purchase price as stated in the invoice and subjected to depreciation charges. So liability also recorded at the value when the liability was incurred when we take loan of 50,000. This value will be recorded as such. Okay. So historical costs, meaning these are the concepts that you are required whenever we record the asset, we record according to the cost that we have incurred at that date time of transaction. Let's say now we are in year 5. So we bought the asset in year 1. So year 1, we bought it for 30,000, like what I've given you the example. The motor vehicle is bought as 30,000. And now we are in year 5. When we do the recording in year 5, we still record 30,000. Why? Because we are following or we are using the historical cost concept. That is, we record according to the cost at the time of the transaction. The time of transaction is year 1. Okay, we are following that. Liability also the same thing. We record the value of the loan according to the record as such, the recorded as such. When we took in year 1, so we record in according to the same amount. So in reality, we know that historical cost of the asset are recorded in account as not realistic because the value of our asset fluctuates very frequently. The value of the asset in the account do not really show the true value whereby the asset can be realized. Okay, so in reality, we should be recording according to the updated value, isn't it? But then we still use this historical cost. Okay, many attempts have been made to record this asset as other than historical costs, like we use replacement costs, we use market price. Nevertheless, this other value cannot be accurately verified. Okay, so meaning if we record replacement cost or market price, so the market price is changing from time to time, isn't it? So if we keep changing the value of the asset, it's not practical, especially when you are using your judgment. So if you're using the judgment, the value is very subjective, not objective, unlike historical cost. Historical cost, you have the evidence that is stated in the invoice. So that's why historical cost concept is still being used with some regular, but then you have regular revaluation being made as and when necessary. Can you understand? Meaning this is the concept guiding us how do we record. You record based on the cost and the prices at the time of transaction, which is evidenced by the source document. So which is more objective value. So we don't record according to the market price or replacement cost because this value is very subjective. So that is historical cost concept. Now, next one is accrual. Okay, they are actually these are two concepts, but it's related with each other. Accrual concept and matching concept. So matching concept is applied in the determination of profit for a particular period. So match, meaning like revenue, we match with the expenses. Okay, that is matching. Matching meaning we are determining the profit, so we have to match the revenue against the expenses. Okay, the cost, the expenses incurred in accounting period are matched with the revenue earned in the same accounting period. So that is matching concept. regardless of the payment made or revenue received. So meaning we don't look at as the revenue money being received, then you match with the expenses that have been paid. Instead, okay, whether it's the revenue earned, you less with expenses incurred. Okay, the meaning of earn meaning not only include the money that is being received in cash, but also money are going to be received later. Like we have receivables, isn't it? Receivables recognized in the sales. So that is actually we are using matching concept. Okay, we recognize that as a sales, even though we have not received yet. Okay, that's why you can see the double entry, which is when we record we debit trade receivable with credit sales. Yeah, debit and credit. Let's say 10,000. So when we do this entry, this is recognizing the credit sales into the sales account, isn't it? This is what we call earn. So in the sales, we have the sales account. So like what you have seen before, we have cash, we have trade receivable, isn't it? So this cash is received, isn't it? Trade receivable, we haven't received the money, but we already recognize. So this is what we call earn. What about expenses? Expenses also the same thing. That is, take a look on purchases. Purchases is an expense, the debit item. So we have cash and we have credit. So this is what we call incurred. Okay, incurred with the revenue earned in the same period. Incurred matched with the revenue earned. So incurred in the accounting period and matched with revenue earned in the same accounting period, regardless the payment made or revenue received. If this is not for this period, we will exclude them from this period as accrual and prepayment. So this is accrual and prepayment. So another concept. Just now we are talking about matching. So matching concept meaning we match the revenue earned against the costs or the expenses incurred. So that is matching. Okay, matching revenue earned against expenses incurred in the same period. If it's not in the same period, then we have to do adjustment. Okay, either we exclude or we plus. We exclude them from this period as accrual and prepayment. Okay, what about accrual concept? Accrual concept, okay, is we recognize, accrual concept is recognizing expenses as it is earned. Recognizing expenses as it is earned. As it is incurred, and revenue as it is earned. So that is accrual concept. So like what we have here, by recording the sales, not only cash, but the credit sales, and even the purchases, not only cash purchases, but credit purchases, this is actually applying the accrual concept. And whether we have received from the customer or not, we will include the sales in the account when the goods or the service have been delivered to the customer. So customer who will owe us are accounted as trade receivable. Whether we have paid to the supplier or not, we will include the purchases, expenses, and accounts once we have received the good or the services. Suppliers whom we have not paid accounted as trade payable. So expenses are recorded in the statement profit or loss when incurred. Similarly, revenue are recorded as we realize sales has taken place. Okay, so that is revenue. I mean, that is accrual concept. So okay, matching, we match the revenue as it is earned against expenses incurred in order to get the actual profit. Accrual concept is recognizing the revenue as it is earned and recognizing expenses as it is incurred. So what is the difference between these two? So matching is a guideline. We only match, okay, revenue as it is earned and expenses as it is incurred in the same accounting period. Okay, and then accrual concept is a method, okay, to guide us how do we recognize the revenue, how do we recognize the expenses. So recognize as it is earned and recognize the expenses as it is incurred. Now, can you understand, class?
Yeah.
Yeah.
Yeah. Okay. Now, next one is dual expect concept. Dual. So dual means we have two effects. There are two aspects of accounting. One represented by the asset of the business and the other by the claim against them. So this is the asset of the business. And this is the claim against them. Let's say the business, so these are the claim, they claim all these assets back. Okay, that is from the outsider and equity is from the owner. Okay. And these two aspects are always equal to each other. So make sure you must ensure this equality is always being observed. It is noted that every business transaction has two effects in the accounting equation. For every change on the left side, there is exactly equal and opposite change in the right side of the accounting equation. After every transaction has taken place, the accounting equation will still balance. So this is what we call dual effect. This also explains the double entry system of recording. For every debit, there must be a credit side. Okay, cannot be both credit, both debit. So it must be the opposite, one debit, one credit. So because of this dual expect concept. Next one, prudence concept, or other name for prudence concept is conservatism concept. So meaning, whenever we use this concept, whenever we are encountering a figure which is an estimate. So this is a guideline. When the figure is an asset or expenses, we should not overestimate. But if we come with liability, I mean, if you categorize that item an estimate of liability or expenses, it should not be understated. So let's go through. In the course of daily work, the accountant often needs to make an estimate. Example of situation that call for estimate is when we decide to write off bad debts, making allowance of doubtful debts, valuation of inventory. So these all are making an estimate. So in coming up with the estimate, the accountant has to exercise a certain degree of caution in the exercise of the judgment required under condition of uncertainty. So we have to be cautious. So first of all, like this item that always need an estimate. So we have to classify them first. This bad debts is an expenses. Okay. What about making allowance of doubtful debts? Also, this is expenses. Valuation of inventory. Inventory is an asset. So we have the guideline. If this is uncertain, I mean uncertain because this is an estimate, so it's not confirmed value. No? So the underlying principle is that the accountant should not paint too good a picture of the business, lest the actual result do not turn out to be so good. In such situation, it is usual for the accountant to be more conscious and conservative, not so optimistic result that may give users false hope. Okay, so this is giving us uh, the reasoning why, if it's an asset, if it's a revenue, so we don't provide that value because it will overstate your revenue, overstate your asset. So meaning if we overstate, we are painting a good picture about the business. So which is if it's, the situation does not happen, so meaning we are giving the user a false hope. So if the actual result is better than expected, very few people will complain, but not the other way around. Okay, that is the problem. So it is this conservative outlook, the accountant give rise to the concept of prudence. Because of this, okay, the accountant is seen to be very negative and risk adverse. So it is not true because one of the most important duties of accountant is to safeguard the business asset and being careful is crucial. So this is the guideline. If it's asset and income should not be overstated. How do you apply this? Meaning, if that item is an estimate and you categorize that item as an asset and income, so we don't provide. Because if you provide that value, the estimate value, then it is overstated. But if it comes to liability and expenses, it should not be understated. Meaning, if that particular item estimate value is a liability, it is an expenses, so we should provide. So that's why we have bad debts. Okay, we have bad debts. So let's say this is the what do you call that? The example. If we have bad debts, so we have to provide. But if we have like future sales but not confirmed yet, we don't provide because that is under income, isn't it? So we cannot overstate the income if it's not confirmed. But if it's liability, we should provide so that all foreseeable losses would be recognized in the account and reported immediately. But any possible profit should not be recognized because it has the possible profit will only be recognized when it actually happened. If it's not confirmed yet, so we don't record. Okay, that is prudence concept. Can you get the concept?
Do they check when they do accounting? They assume everything okay, or nobody
This
made
one
mistake.
is meaning suddenly we have to decide whether do we provide this item in the financial statement. Let's say we have, for instance, bad debts. Bad debts meaning is a confirmed trade receivable not able to make payment. So do we provide in the financial statement? So first thing, but we don't have the actual value. First thing we have to categorize that bad debts is an expenses. So since even though it's not confirmed yet, but we have estimated that amount, so we provide. We provide the bad debts because we are following the prudence concept. This is under expenses. So it should not be understated. If we estimate that this going to happen, so we have to provide. We follow this guideline. We provide the bad debts. But let's say if we have sales, but this is not confirmed yet, so we don't provide. Why? Because we are following. We have to be cautious. We have to be following the prudence concept, which is you classify first. This is an income. So it's not confirmed income. So we should not be overstated. So we don't provide. So that is the guideline. Is that okay? So we
Okay.
follow this guideline.
Okay.
All right. So we have 3 minutes more. So I want you to read on this one, and then I will discuss again during our next class.
This chapter, all theory only.
Yeah, all theory. Okay, you read on and jot down what you don't understand, and we discuss during our next class. Okay.
Okay.
Right. So before you go, any other question you want to ask?
No.
No.
So far, no.
So far,
So the journal question, does it come out often in the exam?
this one,
And the journal.
journal, of course, they will ask, yeah, journal, journal entry, you mean? Yes.
Yeah. Okay.
Okay, sometimes they ask, how do you record in journal? Or probably you need to explain, how should you journalize this? So you must be able to explain what account to be debited, what account to be credited. So you have to be ready on the theory part also. So they are not asking on technical part, that is to do the journal format, but they ask you in theory part. So you should be able to explain what account to be debited, what account to be credited. Right? Okay. So all right. So I'll see you on Thursday.
Okay. Thanks,
Okay,
sir.
sir. Okay, thank you, sir.
Okay, welcome.